Hello and welcome to our conversation on financial statement analysis. The focus of this session is Altman Z-Score. In the past, in one of our discussions, we examined the DuPont framework as a part of the ratio analysis. The DuPont framework makes an effort to decompose return on equity on the basis of profitability, solvency, and efficiency. So DuPont framework says that return on equity depends on the net profit margin, total asset turnover, and financial leverage. However, the DuPont framework, we can see that all ratios are actually given the equal weightage. So there is no distinction on the basis of the weights. Despite the fact that DuPont framework is very popular and useful ratios, but researchers have been examining the relevance of other tools, and one such tool is the Altman Z-Score. The model was developed by Professor Edward Altman in 1968 as a measure of the financial stability of the companies. Altman Z-Score model is a numerical measurement that is used to predict the chances of business going bankrupt. So initially, this model, popularly known as Altman Z-Score, has been designed to identify potential bankrupt firms. So what is this score? The score is equal to 1.2 into x1 plus 1.4 into x2 plus 3.3 into x3, 0.6 into x4 plus 1.0 into x5. Now this 1.2, 1.4, 3.3, 0.6 and 1.0 are the coefficients, or we will, in this presentation, we'll call them as a weights given to the ratios. The x1, x2, x3, x4 and x5 are the relevant ratios. X1 is a working capital by total assets. X2 is a retained earnings by total asset. X3 is the earning before interest and tax by total assets. X4 is the market value of equity by the book value of liabilities. And X5 is the sales by total assets. We'll pick up each one of them and try to understand the relevance of those ratios. But before we do that, let us also get an idea about how these coefficients have been derived by the creator of the model. The multiple discriminant analysis was used to derive that weights or derive that coefficients. Multiple discriminant analysis, MDA, is a statistical technique used to classify an observation into one of the several a priori groupings depending upon the observation's individual characteristics. So based on individual characteristics of two different sets, it is possible, or a particular set, it is possible to divide them, segregate them, and group them into 2 to 3 groups. So in this case, the MDA is primarily used to classify and make predictions and problems where the dependent variable appears in qualitative form. For example, male or female, bankrupt or non-bankrupt firms. So for this paper, the researchers have classified or taken the companies which have filed for bankruptcy, the companies which are sick and not sick, and based on the financial information, they try to classify them into potential sick companies and the companies which will not become sick in the near future. The MDA computes that discriminant coefficients. Those are the coefficients which we mentioned here. Now let us see the ratios which have been used for calculating the Z-score. The first one is X1, working capital by total assets. We know that working capital by total asset is a reflection of liquidity of a company. The liquidity of a company is the ability of the firm to meet the short-term obligation. To do that, we try to compare the current assets and current liabilities. Working capital is normally computed as CA minus CL. So the ability of the firm to meet the obligations, current obligations in specific, that is current liabilities, depends on the amount of working capital, amount of current asset, of course, also on the quality of the current assets. However, in this particular model, the researchers took the total amount of the current assets. And we know that a firm which is experiencing consistent operating losses, when they're not able to generate profit, will generally have a shrinking current assets. So if the current assets reduce, current liability is remaining same or increase, the ability of the firm to meet the short-term obligation will be low. So if the working capital is negative, or if the ratio is negative, so that means working capital is negative, and working capital negative means current assets are less than the current liabilities. The second ratio is a retained earning. X2 is a retained earnings by total asset. Retained earning reports or shows the total amount of reinvested earnings, reinvested profit. Profit can be distributed among the shareholders, or profit can be retained by the company for financing its assets. So if RE by TA is high, is a reflection of the fact that the company is using its own internally generated profit to fuel, to fund, to finance its assets. So if RE by TA is high, that means the company's dependence on the debt is low, and the company's dependence on equity is high, and equity is high because the retained earnings are high. So high retained earnings by total asset is a reflection of a fundamentally sound company. Now let us see X3. X3 is EBIT, earning before interest and taxes by total assets. Unlike the RE shows the profitability up to that period. EBIT shows the profitability for the period. Is the company generating profit in the current year? Did the company generate profit in the past? That has been shown by RE by TA. EBIT by TA will show, is the company able to generate, or will the company generate profit in the year next year? So this ratio measures the operating efficiency of the firm, profit generating ability of the firm. Normally, this is seen as a before interest, before tax. That means without getting affected by the leverage of the company. So if EBIT by TA is high, the profit generating ability of a firm is said to be high. If EBIT by TA is high, the potential to become, or the company becoming sick, is very low. X4, market value of equity by the book value of equity. Equity by total liabilities is also the inverse of the debt equity ratio. Equity here is a combination of the debt, is a combination of common shares, preferred shares, and at the market value. And the liabilities are the obligations of the firm. We know that equity is the residual claim. So if the firm has a high equity, so the ability of the firm to meet the long-term obligation is said to be high. So a firm with a high market value to the market value of equity to total liability ratio is said to be in a very, very safe or a stronger position. X5 is a ratio of sales by total assets. Sales by total assets shows the efficiency of the firm in using the assets, in converting the assets and creating or generating sales. The generating sales means generating profit. Assets are said to be efficient, or a firm is said to be efficient if sales by TA is high. Suppose if a sales by total asset is low or very low, two possibilities. Either the company is not using the assets efficiently, or it is unnecessarily sitting on assets which are idle, which are not adding value, which are not required. Either way, X5, that is sales by TA, is a reflection of efficiency of the firm. So X1, X2, X3, X4, and X5, they all capture profitability, solvency, efficiency, and of course, the profit generating ability of the firm. So if you combine, if we combine all these ratios, multiply the ratio, multiply each ratio with a given weight as determined by the MDA or determined by the model, we get Z-score. So Z-score is a summation of, we can revisit the formula. Z-score is a summation of 1.2 into working capital by total asset plus 1.4 into retained earnings by total asset plus 3.3 into EBIT by total asset plus 0.6 into market value of equity by liabilities of the firm plus 1.0 into sales by total asset. Now, how to use this ratio? The paper says that if a firm with a lower Z-score, the lower Z-score is there is a higher probability, higher possibility of firm becoming bankrupt. So, and has given a cutoff that if the Z-score is less than 1.80, it is said to be, the firm is said to be in a distress zone. And if the Z-score is greater than 2.99, is said to be in a safe zone. Now let us examine this, calculate the Z-score for Indian companies. For this purpose, we will take two companies, Vodafone Idea Limited and Infosys Limited. And the data for this, we used the data from moneycontrol.com. So Vodafone and Infosys are two extremes, we'll say. One belongs to the telecom, other belongs to IT services. Vodafone is fundamentally weak company now. The fundamentals are weak, and they have already knocked the doors of the bankruptcy board. Whereas Infosys fundamentals are very strong. Market is prices is continuously has been rising and performing well in the market for the shareholders. Now let us see the behavior of Z-score for Vodafone and Infosys. Let us see first Vodafone. Before we see the Z-score of Vodafone, let us observe the profit and loss account and the balance sheet of Vodafone for last 5 years, 2017 to 2021. We can see that all the 4 years, 5 years, the company is making or incurring losses. And more important is, losses increase from 831 crore to 46,000 crore. In a matter of 5 years, the loss has increased from 800 crore to 46,000 crore. What is the main reason for that? The reason we can see the sales is more or less constant, 35,000 to 45,000 crore, 41,000 crore. But we can observe that the interest component has been rising extensively during this period. So the company is making loss or incurring loss. Because of that, the reserves and surplus, you can see that has become from 20,000 positive to 66,000 negative, 66,000 crore negative. So the company has become negative equity company in the year 2020 and continues to be a negative equity company in 2021. And more importantly, we can see that on one hand, the equity has become negative. On the other hand, the long-term borrowings increased from 51,000 crore to 157,000 crore. Similarly, the current liability is also increased from 16,000 crore to 65,000 crore. Now, with this information, let us find the Z-score as per the model that we discussed. So we picked up an important, the relevant financial ratios. The relevant financial ratios for this purpose is the financial items. Let us first find the relevant financial items, that is working capital, the total assets. Working capital, we got it from the balance sheet, the current assets and current liabilities, current assets and current liabilities. Then we found, pulled out the total assets of the company, then the retained earnings from the balance sheet. We picked the EBIT from the income statement, though EBIT is not directly given. We added PBT plus finance costs and derived the EBIT. Then total turnover from the income statement. Market value, we derived this, got this number from Provis, and liability is from the balance sheet. And we use these items to derive the relevant financial ratios. X1, that is working capital by total assets. Then X2, that is retained earnings by total assets. Then we found EBIT by total assets. Okay, we use the data that we collected from the financial statements, the market value by liabilities, and then sales by total assets. Then we derived the same ratios for all the 5 years of the study, all 5 years, and use this weights as given in the model to derive the Z-score, So the model is multiplying the weight into the ratio, that is x1 into 1.2, x2 into 1.4, x3 into 3.3, x4 into 0.6, and x5 into 1.0. So then we added them together and we got the Z-score. It's important to observe that the Z-score of Vodafone has been falling from 0.9 to minus 0.54. And as per the cutoffs, this is way below 1.8. So Vodafone has been in a distress zone for quite some time. But let us observe the Z-score of Infosys. We use the same methodology to calculate. We got the data from Money Control, retrieved the data, the relevant data, then calculated the relevant ratios, multiplied the relevant ratios with the weight, and then we got the Z-score. And what we observe is the Z-score of Infosys is way above the 3, which is said to be in a safe zone. And let us also observe that the financial statements of Infosys also reflects that. The PAT is being positive consistently. The reserves are rising, have been increasing over a period of time. There is no borrowings of the company, so no leverage. Retained profits rising, EBIT increasing, revenue increasing, all signs of strong fundamentals of the company. So on one hand, we saw Vodafone, which is making losses, incurring losses for quite some time. The Z-score of Vodafone is way below 1.8, so is said to be in a distress zone, whereas the Z-score of Infosys is way above the 3, which is said to be in a safe zone. However, we should also remember that just by observing two companies' data, it may not be possible to say, okay, Z-score is relevant for India, is applicable, but at least it is able to show that a company which is not doing well is in a distress zone, and a company which is doing well is in a safe zone. But as a student of financial statement analysis, we should remember that the financial statements will give you some numbers, and it is necessary to observe those numbers over a period of time and understand the story behind that numbers. So try to understand both the story and the number, and then create your own personal evaluation for about the company. Altman Z-Score, unlike the conventional financial ratio analysis like DuPont, Altman Z-Score's contribution is it brings weights into the conversation. Moreover, it touches the almost all important aspects of analysis: liquidity, solvency, efficiency, profitability, and then combines them together by giving and assigning certain weight, and it gives a single number. Suppose we say that Z-score of Vodafone is very poor, is in a distress zone, and the management would like to improve the performance, then it gives us a framework where to start and which one to address. So the management may decide that let us improve the current profitability. You cannot do much about the retained earnings. It is about the past. Let us improve X3, that is EBIT by total assets, improve the profit generating ability, and improve the Z-score. Because you improve the profit generating ability, talk about it, create the narratives in the market, the positive message, positive vibes into the market. So then the market value of equity may go up. Make an effort to improve the efficiency of using the assets, that is X5. So a company can expect that Z-score will improve by addressing X3, X4, and X5 itself. Now it depends on the company, which one, which important ratio, which aspect of the business to be picked up. So unlike the conventional ratios, Z-score therefore contributes to the conversation by bringing the weights and summarizing those aspects of the business which are considered to be important. So Altman Z-score can form an important part of a toolbox, the toolbox consisting of different ratios, and along with the conventional ratio analysis like DuPont, we can also use Altman Z-score to analyze the financial statements of a company.